the price of the dollar price, the euro price, the yen price, whatever, of your silver and your gold went down on Friday. The value of them did not.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'm thrilled to be your host for this episode. And from the entire Live from the Vault team around the globe, we extend our heartfelt thanks to you for your unwavering support. And as you might imagine, this community keeps on expanding week by week, and we just couldn't be more excited that you've joined us here. Now, we're in the midst of historic times, as you know, and today we've got the one and only Andrew Maguire in the vault, and he's got a special interim kind of update here due to what's going on in the silver and gold markets recently. As you know, I'm pretty sure you're anxious to hear what Andy has to say in the precious metals industry. And then what he's going to do is he's going to bring on our featured guest today, the one and only Craig Hemke from TF's Metals Report. So with that, let's head over to Andrew Maguire.
So everybody, this is a very important quick interim update to assess what drove the unprecedented gold and silver sell-off, and really to reaffirm that gold 8,000 and silver $140 are absolutely on track. In fact, as we're going to see, the 100% derivative-driven sell-off has reset the most powerful central bank sovereign and institutional physical global rally anchors in both gold and silver, this time with no long speculators to target. Now, without last Friday's officially sanctioned orchestrated bailout, which is what it was, and insufficient silver to meet over 1,500 tons of silver being demanded at the back COMEX door, the entire too big to fail cartel deck of cards would have folded. Now let's follow the footprints. Now, just for the record, I'm recording this just at the PM fix on Wednesday. So just to put that into context, and this is where we were when we did our prior episode. So this is about first notice. Following first notice into Thursday's pit close, and this is the point where all the open interest, all the warrants have to be fully paid up or delivered. And there was 49,455 million ounces of February silver warrants standing for delivery. They had to be fully paid for by way of a cash settlement, or, as should have been the case, 1,538 tons of bullion should have been moved across the warehouse centerline, the blue warehouse centerline, to be physically delivered. But the registered inventory data proves that silver simply wasn't there to deliver. Hence, the single largest official intervention since the 2008 Bear Stearns bailout. We'll look at how this contagion fed into mainland China shortly. As we estimated in our last episode, without a bailout, the entire cartel deck of cards will fold. Now, given there is no silver available to fill the chasm, it meant that significantly higher prices would have to be paid for cash settlements. Now, if you remember, liquidity providers had assessed there might have been just enough takers to let the cartel off the hook at $140 for the next rally point. But following first notice, this looked more like, and here, right at first notice, they realized there was absolutely insufficient silver to meet this demand. Nor even by cash settling, or the cost to cash settle would have been more like about $230 and rising. That was enough to implode the entire derivative daisy chain of too big to fail banks. Hence, this is why they knew that there was going to be insufficient silver at this price. And what they were trying to do was get it down to this level here, or below even, to try and mitigate that by rinsing out as much long interest as they could.
Now, our friend Bill Halter has always maintained silver is the Achilles heel that will one day be the failure, and a failure to deliver will occur, and it will create a trust shock in the derivative market to bring the entire too big to fail 2 quadrillion derivative deck of cards to come tumbling down. Now, also, once a higher price has been validated in the onshore and the western-facing physically settled free trade zone gold and silver corridors, the new benchmark price will have exposed billions of Fed-held OCC unallocated FX bets as undeliverable. And the longer a physical support condition endures, the stickier the rising physical support levels become into a series of higher priced hedging flows, thereby underpinning each physical market support level. Hence, a panicked intervention so large it exposed a deeply offside weak hand.
Now, while we anticipated the obligatory end-of-month selling into billions of dollars of Fed-borrowed gold leases, which have to be marked to market in the Basel III NSFR-compliant FX markets, and this is the FX market, and this is always timed to be collateralized at the CME pit close, which is exactly this point here. Now, the officially orchestrated selling we encountered was far more aggressive than had been anticipated, clearly, but nevertheless, it still fixed gold another $500 higher than the $1,000. It was initially over $1,000 higher. So they managed to retrace it too, but it was still $500 higher than in December. And this is a series of every single month we've seen higher and higher settlements. And this was enough to really force the Fed to buy back leases as at the next series of these higher prices. And in fact, they borrowed 15 tons more, and it still had to be paid back higher. But here's the point. While printing more fiat to buy gold to pay back leases simply raises the price of physical gold, printing more dollars does not buy silver that isn't there. It was derivative silver that really forced the sell-off, forced the official bailout, that is. Now, Fed BIS, that's the Office of the Comptroller FX silver bets that we talk about. These are the Office of the Comptroller is a registered report, and it lists billions of dollars of gold and silver bets, which are unallocated and are not deliverable, basically hedging a derivative. These also get marked to market at exactly that time. So, of course, this is the directly related pit close. So this is the same Bank of International's options point that we saw in gold. And this is where the too big to fail bailout was focused. This evidenced every single trick in the book being exercised, such as 30% margin increases designed to pop the spec bubble, opening COMEX market limit down, driving very large bid-ask spreads into which neutral market makers become naturally unwilling to make markets in. And with the CFTC conveniently largely absent into a partial government shutdown, rampant spoofing was evident. Now, into this directional sell-off, illiquid gold futures bid-ask spreads gapped as wide as an unprecedented $500 per contract. Now, it should be as tight as 10 cents, one tick. And with Shanghai silver also limit down, we evidenced COMEX bid-ask spreads as wide as $1. That's $5,000 per contract equivalent. These unprecedented illiquid conditions exposed the COMEX scam, the scam-enabled momentum traders who really control 80% of all the casino chips. And what it did was saw them flip from long, and they'd been long all the way up here, and they flipped short, and drove the downside action all the way from Friday to Monday's London Open. And this was the London Open here. and better seen in gold at this exact moment was when we evidenced central bank and sovereign buyers returning to buy the dip.
So while spreads were so wide, they were untradeable, very strong central bank sovereign physical demand never wavered in both gold and silver. And throughout the entire sell-off, very large SGE premiums, which net of VAT still exceeded $30 in excess of the COMEX price. And really, so into these lows, we still see China and India trading $100. Revealing, really, what did that reveal? It revealed the selling was 100% COMEX centric. This is the COMEX tail, still wagging the physical dog. But it's a dying tail. And while gold is a liquid, Basel III high quality liquid asset that can be delivered in size at higher prices, when silver is called for delivery in size in the Western asymmetrically imbalanced under priced supply demand structure, which is a derivative structure, there's simply insufficient silver available to buy at any price to deliver. And therein lays the problem and the reason the too big to fail bailout was implemented. While physically backed SGE exchanges reflect a liquid, real-time, physically determined supply-demand price where I have to own a bar to put it for sale. Diluted, leveraged CME, LBMA, unallocated silver contracts, they actually relate to just nothing but a complex synthetic derivative structure. They simply do not reflect the correct price.
There's absolutely no doubt that the cartel operates as an insured agent for the wrong-footed Fed, who audibly holds the short OCC foreign exchange gold and silver book. They actually hold that book. And by Friday, with no silver available to meet delivery obligations, the too big to fail bailout was actioned. Now, the Western bailout tendrils stretch all the way into mainland China, where the only public fund investing in silver futures, which is the Western-sanctioned UBS SDIC Silver Futures Fund, had to be suspended from trading following being overwhelmed by redemption requests they couldn't fulfill. Now, the fund's secondary market price represented a 64% premium over its NAV, which when they shut the door, they literally shut the door to all new subscriptions and left investors exposed to massive losses. Now, to put this fund into perspective, this is a highly speculative derivative fund and is not related to the physically backed SGE exchange. And this is where that was called. Now, bottom line, this fund is so-called, quote unquote, this open-ended fund, so-called hedged clients, these clients' silver investments with related COMEX positions, which became undeliverable when called off for at current prices. And of course, that market just broke. As such, redemption requests were unable to be fulfilled. Now, this redemption crisis contagion has now spread to similar highly leveraged virtual gold and silver platforms, also paper hedging price against a virtual COMEX benchmark. Even though they are not directly using the COMEX, they're using the price as a benchmark. These are derivative positions hedging derivative positions and have nothing to do with the SGE physically backed exchanges. This is one more reason that underpriced COMEX silver is being targeted by real SGE and Indian buyers who are once again lining up for a huge backdoor loadout of 49,455 million ounces, that's 1,538 tons of COMEX silver, which must be fulfilled by the 27th of February. This sell-off was designed to shake out buyers who'd stood for delivery, but here's the problem. Speculators do not stand for delivery. These are real buyers standing for delivery of underpriced bullion to meet physical silver requests they cannot get delivery of anywhere else. It hadn't gone unnoticed, the low 71s, that Shanghai physical silver was trading at a $30 premium to futures, with strong demand evident into the dip at 100. which is where Shanghai was trading. Now, currently, as I record this on Wednesday, the SGE silver price is still $30 higher than SI silver futures, and it's hit its highest February fixed level. And then, of course, what we see is this is the same game we see all over and over again. As soon as it touches moving average, we see the same momentum shorts going short again. Now, this is actually manna from heaven, because what's happening here is the physical markets are literally taking this momentum shorts and converting them into physical. And while this large rinse has basically rinsed out a very large amount of speculators, and we're still seeing 36% backwardated conditions into the London fix. That's $1,800 per contract discount to London, illustrating the official intervention has rinsed out all the speculators, but it's not relieved the CME LBMA shortages, else we wouldn't have these large backwardations. As we'd highlighted in our last episode, the LPMCL short squeeze had crystallized massive losses for the cartel. Net of any legitimate hedging positions, COMEX front-month position limits are limited to 3,000 contracts. Now, that would have netted out to a 19 billion loss per member. And we had an example of that with TD alone. So into unprecedented silver shortages, if a 30% market sell-off could not have been orchestrated, which it was, it would have led to a potential too big to fail daisy chain collapse, and it still might. Any more attempts to target deeper moving averages will backfire. So we have a perfect hit of the 50 here, this is where the buyers came in, and we had a similar hit of the 50-day moving average in gold. This is really the tail wagging the physical dog. Now, the House has thrown as many capping headwinds as possible against gold futures and silver, raising margin costs in gold futures from 6 to 8%, and in silver, 30% higher, from 11% to 15%. However, there are no spec longs left to rinse, so the increased carry across way more on the momentum shorts, who actually control 80% of all the speculative open interest. And they've now flipped from naked long on the way up to naked short, indicating the hard tests of the rising 50-day moving averages in both gold and silver really triggered very large sovereign buying in silver and very, very large central bank buying in gold in very large size. Also institutional buyers, really forging what should be a very solid bottom. Now, while spreads are still wide, they're starting to contract. Now, while Friday through Monday, that is, this absolute sell-off into the London Open. Now, while that has relieved the immediate too big to fail problem, it has yet to fully backfire into known very large central bank sovereign institutional physical buying, as benchmarked by physically blacked SGE fixes, which are steadily undermining the LPMCL's control of FX silver market pricing, forcing unallocated dilutive local London fixes to become deliverable. And this is what's been driving the one-year silver lease costs to around 9%, because the LPMCL has to borrow silver to rob Peter to pay Paul. It has still left a massive physical shortfall yet to be paid back, as benchmarked by SGE physical supply demand prices, where I have to own a bar to put it up for sale. However, SGE positions are physically backed, indicating sub-spot 100 is actually digging a deeper hole for Western officials to climb out from. Now, as we've said, the momentum, the ballooning bubble momentum longs have now gone bubble short. And what they're doing is rising. As we rise up, they're still selling. And what I'm trying to make the point of here is it turned exactly at the 20-day moving average, which is pretty much an institutional level. What they've done is now reverse it back to where the pit closed. Now, it really is just last gaming, but we've seen the price is over $100 right now in Shanghai. So this is ludicrous, and it's being picked up by every single physical buyer right now. Bearing in mind that hedgers and producers no longer play in the COMEX sandpit. You get a far more liquid, reliable supply-demand price, with a lot less volatility than you do in these paper markets. So right now, we're seeing we've seen up to 40 cents, 36-cent backwardated conditions, illustrating the official intervention has not relieved the CME LBMA shortages at all, and that's not gone unnoticed. February gold standing for delivery has 85.6 tons, and while the bailout relieves some pressure, the bulk of the open interest remaining in gold is sticky. All the first-tier liquidity providers we spoke to are reporting very strong central bank, sovereign and institutional demand has stepped up sub-spot 5,000. The only remaining sellers are the momentums, who, as I say, control pretty close to 80% of the COMEX open interest, who've now flipped from bubble long to bubble short, this time with market-making bullion banks all on the long side. The 20% gold drawdown has evidenced fresh calls for $6,300 gold from JP Morgan, Goldman Sachs. We have Deutsche Bank, Saxo, Julius Baer, first-tier liquidity providers, alongside several other major trading houses, in aggregate have expectations that it will take $8,000 gold before any kind of gold exhaustion will be seen. Heraeus also notes retail demand for gold and silver has also returned, with reports of queues in China, Singapore, India to buy the dips. Fundamentally, nothing has changed. Central bank, sovereign and institutional debasement demand continues unabated. And while very short-term price has been driving the action, it's just provided stackers an opportunity to add to the stack, just the same. In silver too, adding to the stack. The pullback through 80 drove very, very strong demand. And bearing in mind, we were talking $30 premiums above this in Shanghai.
So fundamentally, nothing has changed. Central bank, sovereign and institutional debasement demand continues unabated. And while very short-term price has been driving the action, it's just provided stackers an opportunity to add to the stack. So in summary, no one I have spoken to has sold a single ounce of their physical gold or silver into the derivative sell-off. In fact, anyone close to the physical markets realizes this, and therefore realizes it was a bailout, which further underlines the race into physical assets are exposing unfactored derivative stress. And what that's doing is emboldening the race into safe havens to really accelerate. Also, we're evidencing cues around the block into rationed physical supply, evidencing the debasement trade continues front and center. Now, if I want to go and buy a silver bar right now, today, I have to take a lottery ticket. I have to stand outside a bullion dealer and hope I'm called in before the end of the day. That's how tight. I've never seen it this tight. So with that said, I'm going to bring in our good friend Craig. Welcome, brother.
Andy, it's always so good to see you. Gosh, we've known each other a long time, and we've been through a few drawdowns over the years, right? So there's no shortage of stuff for us to discuss.
No, absolutely. And I think this was a doozy, and it exceeded pretty much anything we've ever seen before, even the 2008 Bear Stearns collapse. But actually, I think, Craig, just having spoken to all our contacts and our liquidity providers and one thing and another, this actually was a bailout. That was a bailout. Bear Stearns, we all know, and good old Ted Butler, he did a lot of work on that and proved, pretty much identified the fact that that it was the Bear Stearns silver position that really had to be bailed out. It just wasn't, there was no silver there. And if you remember at the time, JP Morgan, I think, bought it for $2 or whatever it was. It was just like a nominal price. And then we went down from $20 all the way down to 8.5. Well, percentage wise, that was a hell of a retracement. What we just witnessed is quite interesting because this time it's not just a paper market anymore. We've got physical markets in being migrated to the SGE. And we've seen a lot of buyers coming in and saying, thank you very much. In fact, I saw $30 premiums in Shanghai. And in fact, when the price went down to $71 and change, we were still seeing $100 silver in Shanghai. So really interesting.
And that backwardation persists too. Andy, remember it was October the 2nd when we first, really for an extended period of time, saw the spot price trading above the New York futures price. And everyone went, what's going on here? And that got to $2 and $3 as October continued. Well, I saw it earlier this week back to 40 cents, back Tuesday night into Wednesday morning. And so there are all these signs, the lease rates in London, in the price in Shanghai, price has been kicked back. And I think they got even more bang for their buck than what they were expecting, just due to the circumstances of it all last Friday. But as we go forward, nothing has changed. You know, I've seen a lot of analysis this week about, oh, it's just 2011 all over again. And I guess kind of in the scope of the decline, the suddenness of it, the fact that the last month or two has mainly been a commercial short squeeze as the speculators, the hedge funds in COMEX silver have actually been getting short themselves and reducing their net long position while the banks are the ones that have been covering shorts. There are some parallels, but this is not 2011 for a number of reasons. One, on the chart, back in 2011, the decline started on a Sunday night, and then it was every day that next week, another red candle, and here's another margin hike, another red candle. It was about 4 or 5 in a row. This was carried over into Monday, and then, we're bouncing back Tuesday and into Wednesday. It's not the same. Then, as you said, the physical situation it's not comparable at all. We're in a totally different spot than we were in 2011. That was kind of a paper-driven short squeeze event on JP Morgan after they assumed that Bear Stearns position. This is nothing like that at all. So, yeah, we've been knocked back. We were knocked back. Maybe we can get into this. The rationale that was used to start it all last Thursday and into Friday, I think, is completely bogus. This stuff about Warsh to head the Fed. And I think in time, this will all sort itself out. And, after a period of consolidation, we'll head higher again.
Hey, what's changed? I mean, look, I have nobody, Craig, and I bet it's the same. I bet nobody that has sold a single ounce of their silver or gold during this entire physical silver stackers have not sold anything. In fact, all I'm hearing is they've gone in to buy, and we've got evidence of we've got queues round the corner in Australia, in Singapore, in China, people and being limited to you having to draw a lottery card to say, well, you can queue up outside, but we may not even call you in. That's how bad it is. And I don't remember it ever that tight before.
Right. I've seen those anecdotal stories on my site this week too, of, people going to their local coin shop and being told to take a number and the owner saying, yeah, it's 90% buyers. I mean, the mainstream media makes it sound like we got to a point last week where people were raiding, grandma's china closet and taking her silver tea set down to the coin shop. I mean, come on. Look, what happened last week was, yeah, okay, maybe we got a little overstretched to the upside in the last week. Okay. You've seen me do this before. When I used to print charts off by hand and then, get out a ruler and a Sharpie and, draw lines on them. I used to find it. And again, this is not, you can't do this. The lines are there. The candles are there. But I used to find it helpful to take a little can of whiteout. Remember whiteout? The stuff you use?
Yeah.
I take a little whiteout, just white out like the top half of a candle and go, well, if that hadn't happened, if that manipulative event, whatever, if you took that away, it wouldn't look nearly as bad. And I did that yesterday for people on my site. Again, we're not like whistling past the graveyard going, well, let's pretend that never happened. But if you hadn't had that period from about the 22nd through the 29th where, everybody seemed to be piling in. And if silver had kind of peaked out, closer to 100 or something like that, instead of 120, and if gold had peaked out where I thought it would peak out, like 5,200 instead of 5,600, we'd be looking at it now going, okay, what's the big deal? It went down, tapped its 50-day moving average. It's done that multiple times over the last couple of years. Everything be great, but you see these big, massive red candles. And again, that's all part of the psyop. That's why these things are done in the first place. So everybody goes, "Oh God, look at that! That candle is so terrible." Regarding last week, we were looking pretty good Thursday night, and I checked my phone after Shanghai opened, and I went, whoa, we're down to 110 from 117. What's going on here? And these headlines had hit that Trump was going to announce Kevin Warsh as a new head of the Fed. Well, from his list of finalists, everybody knew that's who it was going to be. But this narrative came out that he was somehow going to be hawk, going to be more hawkish than Powell and all this stuff. And I'm like, what are you talking about? Seriously, Andy, do you think, I don't care what people think of Trump, but I don't think he's stupid or a dupe. And certainly Besant isn't. Do you really think they're sitting in the Oval Office, as they're deciding it's going to be Warsh? And Trump and Besant are like, look, we're going to do this. We're going to run it hot. We're going to cut rates as low as we can. We're going to do yield control if we have to, as we meld the Fed and the Treasury together. We're going to do all these things because they've said repeatedly, we got to grow our way out of the debt. Do you really think they're going to, that in that context, they then said, but Kev, you go do whatever you got to do, man. If you're going to hike rates, there's no way that's true. But yet that was the narrative. And so the dollar goes up, the plug gets pulled on the metals, and then, Andy, it's a perfect storm. It's the last day of the month. The London fix is behind us at 10 o'clock Eastern. Shanghai's asleep. All the London guys are already in the bar. And now, boom, the bottom just drops out. And you get all of the excess speculation that was in things like the double long ETFs, like the AGQ. All of a sudden, they're bailing out, and then it's also first notice day for the February gold contract. And if you're in that contract and you don't have the amount of full margin, 100% margin to cover a potential delivery, you get forced out by your margin clerk. So you had all of these things combined last Friday to make this just outsized, ridiculous drop that, like I said, we can't ignore that it happened. But if you just take a step back and look at it, you realize it's not 2011 all over again. It's not 2008. And that was so outrageous what happened. We've just kind of got to keep our wits about us, remember all the fundamental reasons that got us here in the first place, and then we'll plow forward.
Absolutely. And I think it, as you say, it's this synthetic side of the market. If we were a true supply demand physical marketplace, hey, there'd be no surprises. On a daily basis, you'd have a supply demand, as happens in the SGE, as happened in the gold and the silver corridors, which are now setting the price. But you've still got this tail here into the COMEX. And occasionally this tail wags the dog, like we talked about all those years ago. It's still got a little bit of wag to it. And essentially, when you think that the momentums, now these are the guys that control 75 to 80% of all the COMEX open interests in oil and silver primarily. They own a lot in gold, but it's primarily silver and gold. What do? They're in, and they're chasing it like a bubble up.
Yeah.
And you essentially what you're doing is you are raising the physical price as in a sense, because, hey, you want physical, you're buying physical. So, and if it was to have stuck at 120, if it was have been at that level, suddenly you've got the hedgers coming in and saying, okay, well, we'll accept that now and we'll start hedging that price. Hey, that pins the price. So what they had to pull the plug. They had to pull the plug. And that's why it was definitely an official bailout. You suddenly saw, okay, let's throw the kitchen sink at it. I tell you what, That's raised the margins quite significantly in silver, actually, to 15 from 11 to 15%. Was that 30%? I mean, and pull a few bids, as you say, everyone's asleep, and bang, down we go. And nobody I know wanted to make a market. Nobody. How would you? Any neutral market maker would not make a market when we had up to, and this is unbelievable. I've never seen this, Craig, in all the years. I've never seen a $5 spread between a COMEX bid and a COMEX ask. It's 10 cents. It's 10 cents. But I couldn't believe it. I had to double take. It's $5. And my spot liquidity providers were taking spreads almost as wide. Nobody wanted to be involved there. You were hitting the ask. You weren't hitting the bid. You were hitting the ask all the time. So you don't even want a bid price. You're just looking at the ask. And that's really what was happening. It literally, in silver, $1. I mean, like $5,000 a contract difference between the bid and the ask. It was probably worse at some points. Who's going to make a market? So rampant spoofing was evident into that game. And my goodness me, guess what? The CFTC, the government shut down for that day. Nobody was really at the CFTC desk to monitor anything. So, I mean, you talk about a perfect storm.
Well, for sure, Andy. The only thing that it reminded me of, remember the day about April 2020? It was right after COVID when crude oil traded at negative $40 or whatever.
Yeah.
Yeah. That was what came to mind as I was watching the price into the COMEX close, because it would seem like there was just no bid. It was the strangest thing. A couple of other things that happened, though, Andy, that are kind of now working in our favor. One, you and I have discussed, and I'm going to use your term, the fact we've done this for 15 years. The banks, there's a reason why the GLD and SLV metal is custodianed in London. Okay. The banks use that as a flywheel. That was your term. Whenever they need physical metal, they know where the orders are. They can, as authorized participants, they can get the metal out. Did you see on Monday the amount of silver that flowed back into the SLV? Did you see those numbers? It was like 36 million ounces put back.
Yeah.
No, wait a second. I thought that meant that there was retail buy. No, that's all that was borrowed and stolen out of there that then was put back at the lower price. They shook it all out on Friday. So there's that. But second, from an internal standpoint of the paper markets that we have over here in the States, two really important things. The commitment of traders report that I mentioned as of Friday. Okay. So this was surveyed back on Tuesday, the whatever that was, 27th, and reported on Friday. The large speculators called the hedge funds in COMEX silver that whole week were dramatically reducing their net long. And by the time of the survey last Tuesday, we're only net long 7,000 contracts. Back in September, they were net long 44,000. So now with all this selling, the new cot that we'll get here on Friday, you might see the hedge funds actually net short. Well, that's not a sign of a big, massive top. That's a sign of a bottom. And then one more, Andy, as we've washed out this week with the February contract going off the board and all of the selling in silver, we now have the lowest total open interest for total number of contracts in both COMEX gold and COMEX silver since last May. 8-month lows. The last time gold was down this low was right before price rallied 25%. Okay, because the speculators come back in. They've all been washed out. And again, same thing with silver. The last time silver's open interest was this low, the price was 33. Okay, so if you want to, I guess the best term is washout. You've washed out everybody with that move last Friday. Everything's all been reset. And now, like I said, I think because of the fundamental situation, the macro, which again, I like to focus on, I don't see why we don't just, we're going to consolidate. We're not going to go straight back to the highs of last week, but I certainly think those highs will be breached as we get deeper into this year.
I mean, exactly. The debasement trade is suddenly gone away. I mean, Lord. But do you know what was really funny? I wished I could find it in time for this, but I saw something on investment.com came through on my phone, and there was a guy there saying gold could collapse as much as 99.99%. Hang on, is this guy on acid or what is this guy? And he was saying, because the debasement trade may go away. I mean, honestly, Craig, I don't know if you saw that, but it made me laugh. And I think it's just, that's the kind of wrong-footed person who is on the markets and taking short sides. Oh, we must be oversold now. We must be overbought. So let's sell it quickly. Let's hedge ourselves. Let's get out. And I think it's what's interesting about that is because you've got two ends of the spectrum. You've got that end where they just don't understand what they're talking about. How could anyone say that gold could be worth just like $5 or whatever? I mean, it's ludicrous. Right way to the other end, where obviously you've got the momentum speculator who doesn't care about price. He doesn't care about anything. He doesn't care, never going to take delivery. And he will just chase it until it doesn't work. And then they're wrong at both ends. And right now, what we saw is that bubble get popped. And guess what? They don't like flat. They went short. So now we have momentum's equally bubble short. And we see the action today. That's exactly what's happened. They're not out yet. And so they still figure, oh, well, we can continue to sell this a little bit. And we see that get up to the 10-day moving average. Bang. That's, I mean, it's ludicrous. And we were talking about this, I remember a little while back, about moving averages. Hey, moving averages are based on a historical pattern when the physical markets didn't exist. So now you've got that price being set elsewhere. And so those moving averages, yeah, these guys still are the tail and they react to those moving averages, but everyone else is saying, yeah, thank you. I'll take that.
You've got this pretend price, like you said, the dot on a screen that doesn't represent anything. It's not a physical price. It's not something at which people are, taking massive delivery. You got this physical price though, that you find around the world. Shanghai back up over 100 this week. All these disparate prices, Andy, isn't that strange? The Shanghai price, the Dubai price, it's like, well, what is the actual price? Yeah, the phony baloney futures price. Nobody really knows for sure. And that's what, look, yeah, they could raise margins. They've now changed it, as most people know, it's now a percentage of the price of the underlying, which what's funny, Matt, Andy, is when it was 11% of 120 is about the same as 15% of 85. Okay. So on dollar terms, well, that excuse didn't quite work.
Yeah.
Anyway, the main point I want to get back to, I mean, again, what people just what in the West in particular don't think. They think, and particularly in the US, they think it's the dollar that's the stable unit of account. And that everything else fluctuates around the dollar. Okay, because everything's based in dollars per share, dollars per ounce. They think the dollar is what's stable and the gold is what's fluctuating. And that's 180 degrees out of phase. The gold is the stable unit of account. The gold doesn't change. As much as we make fun of the Wall Street Journal for calling it a pet rock and all that stuff, and it's just a shiny piece of metal, it doesn't pay interest, like they say. It to some extent, it's true. The gold doesn't change. What's changing is your purchasing power. What's changing is the value of the underlying fiat currency. 10 years ago, it took $1,200 US dollars to buy that same US gold eagle. 5 years ago, it took 2,000 US dollars to buy that same eagle. Now it takes 5,000 US dollars to buy. What has changed? The eagle hasn't changed, right? It's just still the same thing. What's changed is how many dollars it takes. And that's why this macro is so important. US growing debt $2 trillion a year. Trump comes into office, it's all about Doge and Musk and their austerity, and they're going to cut the deficit by $2 trillion a year and balance the budget. And what that last about 90 days. And they just went, well, that ain't going to work. And the whole message since has been, well, we're going to grow our way out of it. We're going to get the debt service cost to GDP back down under 2%. We're going to get the total debt to GDP back down, and all these different, if we can grow our way out. And that's the notion behind this run it hot stuff, where they're going to cut rates and they're going to, if they have to do yield curve control to keep the long end down, they're going to do that. There's even the stuff out, we're going to remonetize the asset side of the balance sheet. All this stuff is out there, Andy. And so that's why, it's exasperating to see what happened last Friday and the herd mentality, and all these other things that took over, washing price back, in such a historic sell-off. But at the end of the day, if you're a trader, okay. But if you're an investor, if you own the physical precious metals for all of these economic realities, well, whatever. Okay. It was interesting to watch, but it's not like I couldn't sleep Friday night, tossing and turning. Just is what it is. I'm pretty confident that the metals are going to continue to trade higher over time.
Absolutely. And that's regardless of the COMEX. Because, and again, so if I'm a producer, I'm a refiner, I'm exposed. Let's use silver, for example, because it's way more volatile. It's 10x gold. So what am I going to do? Why would I play in that COMEX playpen? I now am in a position where I can go and I can actually hedge my positions. I can hedge my future production in the SGE physically backed gold corridor. Now, if that was because silver really didn't come down that much. You look at the big candles in the COMEX. Hang on, the SGZ silver price there was massive buyers at 100. So hang on, and then it was down to 71, and there's still buyers coming in at 100 because the physical supply demand equilibrium. They figured that was cheap. Now, if I'm a hedger and a producer, why am I going to actually hedge that with the LPMCL or the LBMA or the CME? That's why they've all moved out. And that's why I think open interest is really what remaining open interest is really just a bunch of speculators. And that's pretty much all you're getting out of it anymore.
Yeah. No, and for sure, Andy. It used to be, the all-time high open interest in silver is like 250,000 contracts. We're 142. And gold got to 800,000. It's half of that now. Okay, so yeah, they're losing power and losing influence, and the actual pricing is moving to these physical markets where, look, if you are a manufacturer and you have 1,000 things that go into your product, I don't even care if it's not even a kilogram of silver. Just say it's 10 ounces of silver. You got to have that silver. You can't have 999 things and then not have the silver. And you certainly can't use a COMEX contract to build your battery or your solar panel. Okay. So there's a real shift here in what's happening in these markets. So it's concerning, and you watch all these things move and you're in these massive red candles. But as long as you understand where this is ultimately headed, it doesn't bother you at all. And Andy, the lost in all of this again, because everybody gets so caught up in the price. Remember this rally, I don't know, this extreme rally that we saw in January, all kicked off on January the 1st. And it was straight up for 4 weeks. And what else kicked off on January 1st? The export controls of silver in China.
Yeah.
They announced those back in October. They went into effect January 1st. And now you've got the U.S. just this week announcing, this $12 billion they're going to put into some critical mineral fund, which silver is a part of it, right? So the U.S. is kind of fencing and China is fencing and you're getting, which again, maybe that explains part of this disparate pricing structure around the world, all the different prices you see. But that fundamentally isn't changing. Okay. So again, the fun and games, I think we're the banks have figured out that they're kind of on their um, last legs of having this power that they've had for 50 years to set price based off trading derivatives. You get days like that. Friday probably won't be the last time we see something like that before this all goes away. But in the Andy, I'll just conclude this thought with this. You and I, again, we've talked about these things for years. Um, the price of the dollar price, the euro price, the yen price, whatever, of your silver and your gold went down on Friday. The value of them did not. In fact, you could say they actually got more valuable. They get more valuable every day.
No, that's bang on. And then for example, then you drill up. I mean, I saw Financial Times, this article coming through this morning, pretty much confirming. And they're usually, they've been gold bearish for years, but not so much anymore. And they came through confirming what we're hearing, which is that following this 20% drawdown, we suddenly see JP Morgan, $6,300 gold projections. Goldman Sachs, Deutsche Bank, Saxo Bank, which I respect enormously, Julius Baer, all our first tier liquidity providers. What they're saying is that, and that's alongside other major trading houses, physical trading houses, in aggregate have expectations of significantly higher. In fact, I saw a really good analysis there that said, really, we don't see, given the debasement trade, given all that's going on, the geopolitics, you don't see that going away. We don't really see, we have an expectation that before we see gold exhaustion, it's going to take $8,000 to actually reach exhaustion. So, okay, well, fair enough. But this is a mindset coming through of the very people that used to short the hell out of the product and are now long and are wanting higher prices, as are every central bank. And so really the wind is at the stacker's back, is what we're saying. It's right at your back. No longer is it a headwind. And these are gifts. This is like the bargain basement sale at, where do you have it? Macy's or wherever does it even exist anymore?
Nordstrom Rack.
It's bargain basement time. And good riddance to the speculators who really, without them, I mean, if they weren't involved, wouldn't have this problem.
And it's like the margin rates, Andy. I mean, every time the CME hikes it, and what's Shanghai up to? Just some like 60% or something. It's like, you know what? Hey, let's drain the pool. Let's make it 100% margin on the CME.
Exactly right. We should have 100% margin, please.
I mean, let's just see who's swimming naked and who's not. I mean, this is just nonsense. But of course they won't do that because they're going to try to keep their power as long as they can. But
well, they need to cover some stuff first. They need to cover.
Yeah. Well, and again, Andy, they're in gold since price broke out to new all-time highs now, almost exactly 2 years ago. There has been a steady repeating pattern, which I guess is kind of redundant, a repeating pattern of 20% rallies followed by periods of 2 to 4 month consolidations. And I mean, you've addressed this. I mean, it's like the central banks buy and then they kind of wait to see and establish a new floor and then they go up again. I mean, one of the big news items a week and a half ago was Poland saying they're going to add another 150 metric tons. 150 metric tons. I mean, what's the annual net demand been in the last couple of years? 220 or 250 for the central banks, and here Poland's going to do 150. Oh, and then Tether keeps adding about 25 to 30 tons every quarter. Okay, so that fundamental isn't changing. And so this pattern in the chart of 20% rallies followed by periods of consolidation. You know what we just had, Andy? 20% rally. We went from 4,500. Well, we blew up all the way to 56. Really, I was thinking more like we'd go to 52. We just had another 20% rally. I mean, I said this was coming when I wrote my annual forecast back in early January. So this will happen. We'll go sideways in the summer, then we'll go 20% again and go to 6,000. People are like 6,000. that pattern hasn't changed. It continues. And then you mentioned silver and the moving averages. Silver on New York Stock Exchange option expiration day, which is always the third Friday of every month. Friday, November 21st, traded down and touched its 50-day moving average at 47, mind you. And it has been moving up following the same trend line ever since. Back on Friday and again on Monday, guess what it did? It went down and touched its 50-day moving average. And this is what bull markets do. Even if you're just chasing the dot on the screen, that's what they do. They rally and then they pull back. They find support at places where you'd expect support. Now, if we start making lower lows and lower highs, okay, that's a whole other story. But for now, we keep making higher highs and higher lows. And that's a bull market, regardless of how scary that big red candle is.
I mean, even if gold maintained its value at this price, which is way below what it should be trading at, the amount of dollars that are being debased every day, the amount of all the other fiat currencies are being debased rapidly every day. So that would at least benchmark this debasement. But of course, the reality of it is that, well, actually, if it's debasing, I think I need to convert more of that into physical. Therefore, the price goes up. It's not, as you just said, the price, your eagle hasn't moved anywhere since it was minted. And my sovereign here, what's changed over my sovereigns? Nothing. I mean, I could exchange that for a pound in 1933. And now it hasn't changed, but it's like nearly 800. I mean, sorry, but it didn't go up. It didn't change. And it's like, this is ludicrous. So the whole thing is ludicrous, to be honest.
Do you know who Luke Groman is?
Oh, yeah, no, I do. He's a good chap.
He retweeted this earlier this week. And I remember this happening. Bessent, Secretary of the Treasury, was outside the White House. He'd been meeting with Trump and he walks out. He's standing in the little circle there and he has a little impromptu where he takes a few questions about what was going on. This was October the 22nd. Okay. Which is 9 months after he famously stood in the Oval Office and said Trump was talking about his sovereign wealth fund. And, this critical minerals part would ultimately be part of that. And they said, Trump, how are you going to fund this? And then he goes, well, Scott's got some ideas on that. And Bessent kind of kicks the dirt like, you didn't tell me I was going to be speaking today. So, and he walks into the camera and he says, well, we're going to monetize the asset side of the balance sheet. We're going to stand it up for the American people. And everyone's like, whoa, what? You're going to what? I mean, gold was $2,700 back then when he said that. Okay. This quote from October 22nd, when he was standing outside, Bessent, gold price rising has helped us substantially. And Luke Groman retweeted that yesterday and said, how come nobody talks about this? Gold price rising has helped us substantially. What an odd thing for the Secretary of the Treasury to say, right?
Yeah.
And nobody said, whoa, hold on, Scott, excuse me. Could you elaborate on that? How does this help? Well, I'll tell you how it helps. If they're going to call in all the Fed gold notes that are currently valued at $42.22 and reissue them at either the market price or some higher number so that they can get, call it deficit neutral cash from the Fed to fund, $1 trillion or $2 trillion sovereign wealth fund. That's how they're going to do it. So a higher gold price helps us substantially if that's your plan. And again, that's what Bessent said was the plan on February 3rd of last year. So again, I only bring this up because I try so hard on my site and anytime I do interviews like this to get people to focus on the big picture. Man, we get people go bananas on these days, and then on Twitter now, there are all these people that have minted themselves as experts in the last 6 months that post absolute nonsense about what's, driving price on a certain day. And I'm like, look, let's just keep our eyes on the ball. Let's keep our eye on the big picture. Nothing has changed. in the pattern. Nothing has changed from a monetary or fiscal, responsibility standpoint. The dollar is going to continue to be devalued, which means the gold price is going to continue to go up. And you've got all this other stuff cooking behind the scenes. The gold price is good for the going up, has helped us substantially. You got all these things that are cooking for later this year, Andy. And so, yeah, what a day we had back on Friday. And yeah, it was really interesting to watch. And we can dissect it and kind of do a forensic analysis of all the things that accumulated and caused it. But at the end of the day, it just doesn't matter. It just doesn't. I didn't sell an ounce. I haven't sold a single mining share because again, I'm confident. Always been confident where this is headed, and I continue to be confident in my analysis of where it's headed.
You only have to just take your eye off a 10-minute chart and have a look and see, hang on, gold retraced 3 weeks of rally, 3 weeks of rally, silver, a month, but it did bounce before that the new export controls kicked in. It bounced ahead of that. So,
yeah.
So really, a blink of an eye. When we have our next conversation, Craig, it'll be in the rearview mirror. It's like, already we're seeing central bank demand of 5,000 coming back in. Okay, they're trying to knock it back down again. But guess who's taking the long side? Every single central bank wants a higher price. Every single central bank, without exception. The only thing that really ought to be thought about is when the US revalues gold, for God's sake, audit it. And for God's sake,
good luck with
make
that,
sure,
right.
audit it first, and not just have a quick look and see, oh, it looks shiny in there. I mean, no, a proper forensic audit. And how many ownership claims are on each bar, and settle it. Deal with
Take our
it.
word for it. They're just going to say, no way they're going to audit that. But they're going to say, take our word for it. Oh yeah, no. Why would you even question it? Of course we have the gold. And that's okay. That's a kind of lying, thievery, and deception that you get at the end of the empire. Whatever. Whatever. They won't do that. But again, that doesn't change. That doesn't change what's going on. And
Nothing.
And Andy, even one more thing, anybody can pull up a monthly chart. We get all the hourly chart is this, and even the daily chart, you want to look at with the big candles and all that stuff. But where you really discern the trend, where you find the long-term, the secular bull and bear markets is not in the 15-minute candlestick chart. Okay. You look at the monthly chart. You look at the quarterly chart. You can even look at the annual charts. And the monthly chart of gold, it's got a big long wick hanging out the top. The monthly chart of gold is fantastic. The price at the end of January, the closing price exceeded the intra-month high of the previous month. Okay, previous all-time intra-month high. That's extraordinarily bullish. Now we may, who knows what February has in store. Maybe we'll have a red candle. We'll probably do, who knows? We're due for one, I guess, at some point. But the long-term trend, all this stuff we've been discussing, still remains positive. And so I just beg everybody not to forget why you bought the gold in the first place. And if you're going to go dump it now, and then we're talking $6,000 gold by this summer, you're going to be like, dang, I keep waiting to buy back in. It's like all the people 2 years ago and last year, gold's got to go back to its 200-day moving average, Andy.
Yep. We hear it all the time.
They sold at 3,100 thinking it was going back to 2,700. Then they sold at 3,400 because it had to go back to 3,100 and then never did. And so all they do is chase, and you don't want to get caught in that.
Because it's no longer the historical market has changed. It's because the price is being set in China. It's being set in Asia. It's being set in the physical exchanges. And therefore, these tail-wagging events, that's all they are. All you do is witnessing the death throes of the COMEX. As you say, one day it's going to have to go to 100% because really at this point. And already, if I want to trade on the SGE, I want to be hedging, I want to do it, I have to have a physical bar. I have to own the bar. I'm not going to put it for sale unless I have paid for that bar. So therefore, a real supply demand. And I'm not going to sell it below what I think I can get for it. And if I think, and there's suddenly extra demand, I'm raising my price. There is the price. So you look at the candle bars, and in the last couple of years, that's because the markets are being set outside of this synthetic derivative pile of sugar. I get bleeped every time. I'm learning not to get bleeped.
Andy, you watch your mouth over there.
Brother, it's nice to have you on and to talk some sense into what is some very short-term stuff and stackers, are just loving this. And if you can even get silver right now, if you can possibly get it, I'd get it personally. I'm going out and buying scrap silver at the moment. Nice objects, but they call them scrap, but they're lovely objects because really I can't really get what I want in the form of bars at this point. So yeah, I'm not going to stop. I've been buying silver at auction since I've been 12, to be honest. And so there's always a way.
For sure. And I'd just add one last thought for the people that are trading mining shares. It's still, people say, well, no, it's not over. I mean, you use a baseball analogy, man, that game is just getting underway. You can tell just by watching the chart every day, the entire mining sector is still completely driven by day trading algos and the ETFs. If the metals are higher by 5-8%, you might get a gap up in the shares. And then if the metals start trading lower during New York Stock Exchange hours, then the miners go right down with them. Again, the fundamentals don't matter. It's just these machines that are trading. What we're waiting for is the actual real cash to come in, to actually start chasing and that we're a long ways from that. And how much cash, Andy? What's the market cap of the 5 biggest stocks? Something like $21 trillion. What's the market cap of the GDX? 30 billion.
Yeah.
Okay. So if you took 1% of the cash out of just the invested cash out of the big 5 stocks, 1%, you could buy yourself 6 or 7 GDXs, not 6 or 7 shares, 6 or 7 versions of the entire friggin' fund. Okay.
Yeah.
So
amazing.
We ain't seen nothing yet. And then finally, I mean, we're getting into earnings, fourth quarter earnings. In the third quarter, these companies made all this money based off of like $39 silver and $3,400, $3,500 gold. In the fourth quarter, it was more like $56 silver and maybe $4,100 gold. So you're going to have these fourth quarter earnings, and quarter over quarter and year over year are going to be mind blowing. And then at some point, someone's going to go, wait a second, silver's not $59 anymore either. And so I think there's still you look at some of these mining shares, and again, people like, no, it is not over. It's just barely started. And so if you were looking to further hedge yourself against inflation, that's probably a good place to be too.
Sage advice. And I say, I know you're not giving advice, but essentially that's really sage thinking, because one needs to be looking at these things and saying, it's the bigger picture. It all adds up, doesn't it? And stop focusing on a 10-minute chart. Really, if you're the problem. And other than that, literally take this gift that's been given to us. And yes, we may even seen some more opportunities to even get a little better, but I'm not even thinking about that. Average in, always done, all the years that you and I have been speaking. Just say, people ask you the question, well, when should I get in? Every month, just a bit, whatever you can spare. Why not? I mean, and it served you well, and it will continue to serve you well because they keep printing more dollars. So it's not really, it's a no-brainer. But Craig, thank you for sharing your time with us today. But people can visit you at tfmetals.com.
TF Metals Report.
Report.com. They are TF Metals Report. And basically, they can parachute in on you every day and get a little bit more information. And what we've done is a bit of an update here based upon an event that needed discussing, basically. And I really appreciate you parachuting in and saying, "Hey, let's banter this around a little bit and see what shakes out."
Well, and again, I just think it's very important that people stay on the long term. I had my site for 15 years, and I've gotten quite a number of emails in the last year or so from people saying, you know what, thank you for keeping me invested because, man, it looked pretty bleak in 2015 or it looked pretty bleak in 2021. But you just kept assuring us that the math was the math and this was all going to work out. And I always tell people, it's not like I'm some genius or wizard, with a crystal ball. The math is the math. It's all going to work out. And so that's what we have to remember. We had this terrible day on Friday. It won't be the last time that happens. As long as we still have these digital derivative, these phony baloney derivative markets, it's going to happen again. Maybe, hopefully not as bad as it was, but those types of things are going to continue to happen. But we have to focus on the long term. And if the central banks are accumulating gold, taking their dollar reserves and euro reserves and accumulating gold, then, well, that's what you should do too. And prepare for the eventuality of where this is headed, this kind of debt-based collapse that just spirals out of control at the end. And gold and silver will always be your best hedge against that and your personal protection.
Well, I mean, that's a perfect place to end because that is it. That's the bottom line of it. Physical gold, physical silver, nothing else. And you have done everything you can. You don't know what's going to come down the pike, but at least you've done everything you can to protect your existing wealth because it's being depreciated rapidly under your nose. So, but thanks, Craig, for joining us. I really encourage people to land on your site. It costs very little to get a daily update and a daily report. It's second to none. And thank you for spending a little time with us today in your busy schedule to just give us your thoughts. But thank you.
Thanks for joining us on this episode of Live from the Vault, brought to you by Kinesis Money. And a huge thanks to Andrew Maguire and our featured guest, Mr. Craig Hemke, for cutting through all the noise and sharing insights that you just won't find anywhere else. Now, if you like this episode, make sure you're subscribed. Turn on your notifications so you never miss out as we go live here. And don't forget to share this episode with someone who really needs to hear the real story behind the headlines. Now, we're back soon with more hard-hitting truths from inside the precious metal space. And until then, thanks for watching, and we'll see you here next time on Live from the Vault. Bye for now.